Warren Buffett-Style stock analysis. Legence LGN. Step 1. Business quality and economic moat. Company name and ticker. Legence LGN. Business model. What does Legence do? Legence is an engineering and infrastructure services company focused on making large mission-critical buildings, such as hospitals, data centers, labs, schools, more energy efficient, reliable, and sustainable. The company provides a comprehensive suite of services across the building lifecycle, including engineering and design, custom solutions for HVAC, electrical, plumbing, and building controls. Installation and construction. Building and installing these systems in new or existing facilities. Maintenance and service. Ongoing support to keep systems running efficiently. Energy efficiency consulting. Helping clients reduce energy use, cut costs, and lower carbon emissions through retrofits and upgrades. Legence operates as a one-stop shop for building systems, serving clients in sectors where reliability and efficiency are critical. The company has a national footprint with over 70 offices and more than 6,000 employees, and is trusted by over 60% of NASDAQ 100 companies for their building needs. Is it easy to understand? Yes. Legence helps keep essential buildings running safely, efficiently, and sustainably by designing, building, and maintaining their core systems. Economic moat. Does Legence have a durable competitive advantage? Potential moat sources? Cost advantage. If Legence can deliver services at a lower cost due to scale or technology, it may enjoy higher margins or pricing power. Intangible assets, brand reputation, proprietary technology, and exclusive contracts with major clients, for example, NASDAQ 100 companies. Provides some moat. Switching costs. Deep integration of Legence's systems into client operations may create high switching costs, making it difficult for clients to change providers. Efficient scale. Legence's focus on large, complex, mission-critical facilities in a fragmented industry may give it a scale advantage in certain niches. Assessment. Legence appears to have some competitive advantages, especially in brand reputation, client relationships, and scale in mission-critical sectors. However, the durability of its moat is not as strong or unassailable as classic Buffett-wide moat companies. The industry is competitive, and while Legence is well-positioned, its moat is likely moderate rather than wide. Management. Is leadership competent and trustworthy? Ownership. Legence is majority owned by Blackstone, the world's largest alternative asset manager, which brings significant oversight and strategic direction. Track record. Under Blackstone's ownership since 2020, Legence has demonstrated revenue and profit growth and is now pursuing an IPO. Capital allocation. Management has prioritized deleveraging using IPO proceeds to repay debt, growth investments, and operational improvements. Insider ownership. Blackstone's large stake aligns management with shareholder interests, but public insider ownership details are not yet available due to the recent IPO assessment. Management, under Blackstone's strategic direction, has a solid track record of growth and prudent capital allocation. The focus on deleveraging and operational improvement is positive, but the high leverage see below is a concern. Step 2. Financial health check metric. Current value Buffett target pass. Return on equity not available. 15% unknown debt to equity. 993.56% Merck. 0.5 no free cash flow. Not available. Consistent. Growing unknown net profit margin. Not available. Stable. Expanding unknown. 5-year earnings growth. Not available. Consistent. Unknown row. Not directly available. Needs to be calculated from financial statements. Debt to equity. Extremely high at 993.56%. Indicating significant leverage and failing Buffett's conservative threshold. Free cash flow, net profit margin, earnings growth. Not directly available. Would require detailed review of financial statements or data providers. Key concern. Legence's very high leverage is a major red flag from a Buffett perspective. The company is in the process of deleveraging, but current debt levels are well above conservative value investing standards. Step 3. Valuation analysis metric. Legence LGN. Industry average construction and engineering. Stock price $30.50 PE ratio. NA negative EPS 24.08 PEB ratio. 17.97 to 2.02, 4.0 current stock price, $30.50 as of September 12, 2025. PE ratio, not meaningful due to negative earnings. TTM net loss of $46.27 million. PS 84 cents. P/B ratio, 17.97, which is extremely high compared to the industry average of 2 to 4. Discount rate, 10-year Treasury yield is approximately 4.3% as of September 2025. Add 4 to 6% risk premium for a discount rate of 8.3 to 10.3%. Intrinsic value estimate. Not possible to calculate accurately without positive earnings and free cash flow projections. The high PB and negative earnings suggest the stock is trading at a significant premium to book value, likely based on growth expectations rather than current profitability. Margin of safety, not present. The current price is well above book value, and the company is not profitable on a trailing basis. Step 4. Long-term outlook industry trends. Growth. The global engineering services market is projected to grow at a 4.626% CAGR through 2034, driven by infrastructure modernization, sustainability, and digital transformation. Tailwinds. Massive government infrastructure spending. Its sustainability mandates and digital transformation are all strong growth drivers. Challenges. Talent shortages, economic headwinds, and regulatory complexity are ongoing risks. Competitive position. Legence is well positioned in high-value, mission-critical sectors and has a strong reputation with major clients. The company's scale, national footprint, focus on sustainability and energy efficiency are competitive advantages, but the industry remains competitive and fragmented. Reinvestment opportunities. Legence is actively reinvesting in growth through partnerships, acquisitions, and sustainability solutions. The company's capital allocation strategy is focused on working capital management, strategic resource allocation, and disciplined return measurement. Step 5. Final Buffett-Style assessment metric. Buffett Standard Current Value Pass. Understandable business. Strong economic moat. Yes. Moderate partial. Row 15% not available. Unknown debt equity. 0.5993.56%. No consistent FCF. Yes. Not available. Unknown. PE reasonable versus HIST. Yes. NA negative EPS. No margin of safety. Price for no high PB. Unprofitable. No trustworthy management. Yes. Yes. Blackstone oversight. Yes. Overall verdict. Legence is an understandable business with a strong industry position and reputable management, but it currently fails key Buffett criteria for financial health and valuation. The company's extremely high leverage DE, approximately 994%. Lack of profitability, negative earnings, an APB ratio far above industry norms make it unsuitable for a conservative, value-oriented investor at this time. While industry trends and Legence's growth prospects are attractive, the absence of a margin of safety and the company's current financial profile suggests caution. Summary. Legence is a promising growth story in a strong sector, but its high leverage, lack of current profitability, and premium valuation mean it does not meet Buffett's strict investment standards. Wait for evidence of sustained profitability, deleveraging, and a more reasonable valuation before considering an investment. If you need a more detailed intrinsic value calculation or want to revisit the analysis as new financials are released, let me know.